Anil Manghnani, Director at Modern Shares and Stockbrokers, now joins us. Anil, good afternoon. Do you think that the sort of move that we have seen in the last 3-4 months, we are retracing some of the gains that we had seen?
See, I mean, at the end of the day, at some point, markets are going to correct. We cannot expect them to go. I know it sounds like a cliche that, but we have gone from 6,800 to 8,700 without a correction, which in my lifetime I've never seen something like that. Maybe the only time I saw that was in 2009 when we started to rally from the 2,500 levels. But even that, when we hit those 25 and 2,200 levels on the Nifty, we spent 6 months there, tested it again and again and again, made a base and then rallied. In this case, we've just hit 6,800 and bounced off. So I've never seen a move. Maybe it's something new that we are learning that markets can do. But, if it were to fall, people would say, okay, it's gone up so much, so what's the big deal? All good things do come into an end. I'm not saying the rally is to an end, but everything has to correct at some point. I mean, remember, stocks have gone up 100, 200% in the last 5 months. And to be honest also, it could be a case of buy on expectation, sell on news. So, even though people are saying GST is a good thing, and yes it is, and yes it is, but maybe at some point it gets factored into the price. So the market is rallying on good monsoon. The monsoon is good, we know that. So the market has moved up. The market is rallying on GST. Pretty much now it seems like a done deal, at least from what I hear in the news. So even if that is done, then why should market go up will be the next question when we already know the news. And maybe we need to find some new news for the market to go up. Because remember, I am not an expert on fundamentals, but from whatever I hear on the TV, that this has been a muted quarter with minimal growth in both revenue and in profit. So obviously the market is already discounted next 2 or 3 or 4 quarters of numbers. So if that also is in the price, if the monsoon also is in the price, and if the GST is also in the price, then maybe now that news is over and that event will not be a gap up of whatever 300-400 points that people say it can be, or maybe you'll have a small gap up and that will be the end of it. I don't know, because many times we have seen on event days like, RBI policy days, if the market has run up too much in anticipation of the policy, even if you get a good rate cut, they do correct. So it could be one of those scenarios, I don't know, but it does appear that the market, having rallied from 6,800 to 8,700, is giving back some. And I think you got to take it in stride that, some of these stocks have gone up a little too much.
Most of the global markets have also rallied. So we are seeing, probably we are seeing, some sort of retracement across the globe.
Possible. I think more clear in Europe to begin with. US, not so much, because even though the Dow may have fallen for 7 days in a row, the total fall is like I calculate some 220 or 250 points, which in percentages terms, it's like 1.3% over 7 days. So it's correcting, but at a very snail pace as far as the S&P and Dow, because I believe the S&P made even a new life high on Monday, if I'm not mistaken. So it is just an early start. Is it overdue? Yes, I think so. In all fairness, even the S&P has rallied from 1,800 odd levels to almost 2,200. So that's a big move of almost 20%. So I think, sorry, not 20%, but almost. But I think given that, I think the more vulnerable markets, again, although Brexit seems to be out of the way, I think the more vulnerable markets are Europe, because they are still nowhere near their all-time highs. So while the S&P has made an all-time high, just to give you an example, the DAX rallied to 10,000, almost 450 in the last move. But its all-time high is 12,500, so it's still 20% from its all-time high. So I think those markets which have not made new highs are more susceptible to a bigger fall. And I think Europe, if we fell, would lead. And it's interesting how correlations are not really playing out, because I'll give you 2 instances when the market corrected globally. One was when oil collapsed to 26, that was one of the reasons given for markets to correct. And the second was when the yield collapsed earlier in Jan-Feb. That was another reason given for why the global markets corrected. Interestingly, post-Brexit, the yield collapsed to a new low as far as the 10-year US. Now it's bounced back to 150s odd, but it went to 130s, which was a new low. But that time nobody was saying that the markets are rallying and why is yield correcting, or vice versa, the yields are correcting, why is market rallying? So that correlation was not being used. And again, oil correcting from 51 to 39, nobody was talking about where's the correlation between oil and stock markets, which last year at one point when markets were correcting, people said markets are correcting because oil is correcting, because commodities are falling. So these correlations don't work out point to point. They play out over an extended period of time. But I just feel that, with yield so low, with oil correcting, maybe the markets are due for a correction. I don't know. But in the past, that is the reason being given for equity corrections, that oil is falling and yields are falling. But this time, people seem to be ignoring it, at least for now.
Do you think that oil correction, if it continues, that could become a concern? Because right now it's just 15-20%.
It's not just 15-20, from it's over 20%, and I don't know, they're obsessed with the numbers in bear market. So I read a statement at 41 that oil is in bear market territory because it's corrected 20% from 51. But for me, oil was always in a bear market because it's corrected from 120 to 26. So how it came out of a bear market at 51, I don't understand. But that's the lingo they tend to use in the West. So we'll go by it. But they're already obsessed about the fact that it's in bear market territory. So obviously it is sending some jitters. The immediate support for oil in the light crude is 38.90, and if it breaks 36.20. But yes, I think if it continues to correct, it is going to have some effect on global equities. I don't think it will be that discorrelation, if that's the correct word to use, will last for too long. At some point, I think equity also will add up. The other thing is, again, when the yen rallied from 125 to 111 in Jan-Feb, yen was being, said that yen is a risk-off currency, and whenever the yen rallies, that is bad for equity. So if that is the case, the yen is at 100 today, and it was at 99 or something on the day of Brexit. So we can't one day say that yen is rallying because of the lack of the stimulus which we expected, and one day say that yen is rallying because of risk off. It has to be all the time. So I think already there are signs with oil sell-off, with yields low, with yen rally, that there is some risk of. Gold is again back at 1370, which is the highest we have seen in like 12 months or whatever. So while equity is not playing catch up on the downside for the time being, there are signs. I'm not sure how much they'll play out in the medium to long term, but there are signs that something is not adding up. Where traditionally you would associate a sort of oil fall to equities correct, or a yield fall to equities correct, or a yen rally to equities correct. But it's not happening, so we'll have to wait to see how it pans out. My guess is some sort of equity correction may happen just because of all these in the medium term.